What is up, guys? Welcome back to the channel. My name is Bryan Carreto, and on this channel, I help simplify all things accounting related for you. So today, what we're going to be going over, today is actually part of our, let me move this over. Today is part of our audit series number 6. If you haven't watched the first 5 parts of our audit series, I highly recommend you do. What my whole goal behind doing these audit series is essentially for someone to be able to come to my channel and literally watch from audit series number 1 to audit series, God knows how many we're going to do, because we're literally going to go over the entire audit process from planning all the way through literally testing every single account. I've seen your messages, cash, AR, PP&E, revenue. We're going to go over everything. And my goal is ideally by the end of 2025, it's currently July 18th today, we're going to be literally through an entire audit file. And hopefully from there, whether you're an intern, first year, or senior associate, you can literally pick up any video from this and learn how to do that certain section that you're maybe working on or you want to learn more about through watching these videos. So hopefully, but again, and I don't know, and I really want your guys' feedback, and it'd be great to just, again, I really want to make this more a community, and that's where I feel like I've kind of been lacking, but yeah, I want to make sure that you guys actually get a lot from it, and I can go over the theory all day, but what really helps me and what really helped me was actually going through like an actual audit work paper. That's what really helped me really excel in my career. So we're going to go through it today, how it would look, and obviously, just keep this in mind, whatever firm you're going to be at or whatever firm you're going to be working at, every firm's going to have their own audit methodology. They're going to have their own software. So you're going to just have to keep that in mind. But hopefully from these videos, they give you a good baseline understanding of what it is. So, okay, let's get into it. All right. So, and again, I really want you guys, if you watch this video, the few of you that do, if you could just comment and tell me kind of what's helping, what's not, because typically I start off with like the theory behind these videos, like it's really scripted. It has a bunch of cuts. But to be fair with you guys, I don't know. I just like doing videos where I don't have any edits. I just kind of talk and I teach and I do what I do best, which is I just don't like being scripted. But again, I just really want to know. I'm going to just start off this video. Typically, again, I go over the theory first, but this one, I'm just said, you know what? I'm going to just kind of go through the motions and go through the actual testing work paper, which again, you could find this template, and I provide this template on my website, bryancarretocpa.com. Go there, download the template or any of our audit series templates, and I'll start uploading more templates. Again, just like things that have helped me throughout my career that I think are going to be very beneficial to you as you're going through. Okay, great. So let's get into it. So as you guys can see here, and we're going to get some water, and if you can, pause this video right now, go download the template from my website. So you can kind of follow along and you can kind of see what I'm doing. So again, I always want to make sure, you always want to start off here on your work papers with actually putting your name. So obviously you would put your firm name, or I'm sorry, whatever company you're auditing. So we have CPA Advisors LLC. We have assessing significant accounting estimates. So we're going to essentially name what the work paper is, right? So what we're going to be doing here, we're going to be assessing significant accounts, estimates, and significant risk. We will probably update that, so you can just hit F2 there. Significant accounts, significant estimates, and let's say significant risk. Beautiful. Okay, awesome. And then the year and date, whatever you're auditing. Again, I always want to make sure you have as aesthetic work papers as possible, because the whole idea behind this is you want to make sure that when someone's reviewing your work, you want to get the least amount of review questions or review notes from, again, your partner, your senior manager, whoever's going to review your work. You want to make sure that they give you the least amount of questions or review notes possible. And the only way you're going to achieve that is by being as documenting everything to the best of your ability. So let's continue on. So we want to make sure we add some type of purpose, procedure, conclusion, or a note on the work paper, letting the reviewer or whoever's going to look through this work paper, letting them know exactly, hey, this is what I'm going to do in this work paper. This is the whole purpose why I'm preparing this. This is why I'm documenting this. And as we read along in our example here, this work paper documents our assessment of financial statement accounts to identify those that are material, involve management estimates, or pose a heightened risk of material misstatement. For each account, we evaluated materiality, complexity, and susceptibility to error or fraud, and concluded whether it should be considered significant or a significant risk. Again, you can kind of read through that, skip back as you need to, but we'll kind of go through this work paper now. And first, we're going to go through our estimation. So I actually, the materiality video is going to be our audit series number 5. So that video is going to be how we calculate our materiality. So go back there, watch that video, and you'll be able to see how we actually calculate our materiality, how we document that, how we even come up with a materiality threshold. So in our example here, we're already done. And so we're going to start off with a significant account. So we're going to go ahead and do, we're going to minimize this a little bit. We're going to do freeze pane. So we're going to do Alt-WFF. That just freezes our work paper the way it is right there. So we're able to kind of look through everything and analyze it correctly. So the first thing, so I'm going to go over the definition of a significant account. So a significant account is one that could reasonably contain a material misstatement, individually or when aggregated with others. But it's not just about size. We should also consider susceptibility to error or fraud, the volume of transactions, the complexity of accounting or required estimates, exposure to loss or contingent liabilities, and the nature of the account, whether it's subjective or there's judgment involved. So as we continue on here, so let's go through. So typically you're going to have, like, in your audit software, you'll go through and then you'll pretty much dictate, like, okay, it's going to tell you, and this is going to determine, the first thing you need to do, you need to determine if something is quantitatively significant, whether from a dollar perspective, it's above your materiality. That by default is going to consider it a material account, and it technically should be in scope. In my experience, in my career, I've never been able, you cannot scope out an account that is material, that is quantitatively material, okay? There's a difference between quantitatively material and qualitatively material. Quantitatively, you have to look, obviously, like in the word, you have to look at it from a quantitative perspective. I know I use the same word in the definition, but you have to look at it from a dollar perspective and whether it's material to the financials or not. And since in our example, our materiality is 1.4 million, I just had a formula to say, okay, I put a conditional formatting to say, okay, if the account is quantitatively material, in other words, if the dollar value of the account is more than my materiality, I have to select it for testing. Or, yeah, you have to select it for testing. I can't see where you would be able to scope out and say, hey, this account is not material when it clearly is quantitatively material. So that's all we did here. So I'm going to filter this. So Alt down arrow, and then you're going to go and just filter all the yeses. So pretty much we just had a formula to say, okay, hey, Excel, give me all the numbers that are quantitatively material. And as you can see here, we have cash, accounts receivable, 5.4 million, inventory, 3.5 million. Hopefully you guys can see that. Let me make that a little bigger. We have inventory, 3.5 million, PP&E, 2.1 million, right of use asset, 1.2 million. And again, this is because it is greater than performance materiality. So that's what we're going to use to determine if it's material or not. And again, our materiality thresholds, we calculated that and we went over that whole video in our audit series number 5. So go ahead and go back and look at that video if you have any questions, and then that'll answer how to calculate materiality. But once you calculate materiality, this is the next step. Now you need to determine, obviously, if accounts are quantitatively, qualitative material, if there's significant accounting estimates and significant risk. So again, then typically your audit software, regardless of what firm you're at, they should be able to give you something and say, hey, look, this is a form, and it's good. And most of the audit softwares I've seen, and most people that I've talked to in the industry still, they pretty much tell me, like, yeah, everything's kind of auto-populated for you. So you'll put in the numbers. It'll pretty much get the numbers from the trial balance that you upload in your audit software, and it'll pretty much automatically say, hey, auditor, you need to pick this number up because it's quantitatively material. And if you change it for whatever reason, it'll give you like a red error message, like, hey, you're overriding our system of controls. Why are you overriding it? And I'm not saying it's wrong, but you need to justify why. So essentially, that's all we did here. You need to determine, first of all, if it's quantitatively material, which would be considered a significant account. Okay, so that's pretty much it. Again, if it's a significant account, if it's quantitatively material, that's the first step, right? Next step, we need to ask ourselves if there's estimation involved in the account. Okay, so typical accounting estimates, and I'll go through this here, so for example, with cash, does that have an estimate? Well, no, not really, right? Cash is cash. Accounts receivable, yes. If you're obviously up to date with all the accounting standards and everything that's come out in the last few years, now we have CECL, so it's ASC 326, I believe. And then that essentially says if it's allowance for credit losses, so that's an estimate, right? That's an estimate that companies have to make to essentially assess how much of their AR is going to be collectible at a certain point in time, right? So that's essentially, yes, there's an estimation involved with that. Inventory also, there's slow moving inventory, there's obsolescence. essence. So that's another thing we also need to consider that is also a estimate. There's an estimate involved in inventory because again, if it's slow moving, let's say for example, and the easiest way I can explain this is, let's say you have inventory on hand on your balance sheet at year end, and there's a certain amount that maybe is projected to not be sold in the next year. Well, you need to reserve for that inventory. You essentially need to debit your cost of goods sold and credit your inventory reserve. Well, that's an estimate. That's an estimate that management needs to make, and that needs to be reflected on the financials, because on the financial statements, your inventory is going to be reflected net of your inventory reserve. So you need to reserve for that, right? So yes, there's an estimate involved with inventory. Property, plant, equipment, is there an estimate involved there? Yeah. When you think about the useful lives, because when you calculate depreciation on your fixed assets, you need to think about what's the useful life of this asset and how am I going to be able to depreciate it over the useful life. Let's say, for example, I don't know, you have computers for 3 to 5 years is typically reasonable, but let's say you're depreciating your computers over 1 year. Well, you would say, hey, I don't necessarily know if that's okay. Let's say you have huge machinery that has a useful life of 10 years, and again, you're depreciating that over 1 year. Typically, the risk is that they depreciate it too quickly, but there's also a risk that they cannot depreciate it at all. Like, let's say, for example, again, if you have computers and you're going to depreciate that over 20 years, it's like, wait a minute here. We all know, like, do computers last 20 years? No, they're usually out of date within 3 to 5 years, right? So again, that's how you guys need to start thinking about this. Literally take into account, and when you're going through your planning procedures, whether you're on your job or school, whatever you're doing, you want to really make sure and you analyze each account. And I'm telling you, this is going to really help you in the entirety of your career, because you're really going to be able to dissect accounts and identify if something is, again, if there's an estimate involved in an account, whether it's material. But let's continue on. So again, right of use asset, is there an estimate involved there? I guess you can say yes depends on what I don't want to get too technical in this video. I just want to make sure you highlight the key things. But for the example's sake, for the right of use asset, we're going to say they're going to elect a risk-free rate, and there's really no estimate involved in here, right? Because you're going to do your right of use asset over the lease term, and you're going to use a risk-free rate, so no really estimate involved there. Accounts payable, is there an estimate? No. We have invoices, we need to pay them, right? Accrued expenses, yeah, there's estimates involved because there's accrued bonuses, there's accrued payroll, there's interest expense they might need to accrue for at the end of the year. So we see some estimates there. Notes payable, no. I mean, essentially, it's debt that we have from the bank. No payable long term, no. Equity, no. There's no estimation involved there. Oh, hey, let's okay. And then I took out the filter. But you know what? Let's go back to the filter. And okay. Well, you know what? Okay, sorry. Let me go back. Okay, sorry, my bad. So revenue. So we're at revenue. We're at variable consideration. Yes, in revenue, is there an estimate involved there? Yeah, there could be, because essentially there's variable consideration, right? Again, I don't want to get too technical and down these rabbit holes of going through each account, but you really just think about it. Like, hey, do we have an estimate in this account? If not, then we move on and we document why we don't. So cost of goods sold, no, there's no estimate involved. SG&A, selling general administrative expenses, that's really just an invoice we get from our vendors or the service people that provide a service to us. So we're just going to say no, we're going to move on. Interest income, no. Other income, yeah, no estimate involved. So let's continue on. Great. So now we have the estimates involved in our financial statements. So then risk of misstatement. So this is really going to be contingent on whether it's quantitatively significant, and also if there's a lot of if it's susceptible to either fraud, or if it has inherent risk as far as, okay, is it determined on some like really complex transaction? Is there a valuation team involved? And as you guys can start picking up on accounts, like once you start really getting comfortable with certain account balances, you'll start realizing how these accounts are composed, how they're recorded, how they come up, and then you'll determine whether they are material, again, whether there's an estimate involved. And now we're talking about if there's a risk of misstatement. And again, that's the risk of misstatement is going to be really contingent upon if it's quantitatively significant, qualitative factors, and other things like that. But just, again, it's really just going through each account one by one and asking yourself how it impacts the financial statements and how these accounts are recorded. So risk of misstatement, cash. I mean, cash is cash, right? We're going to do some testing over it. It's susceptible to fraud, but at the same time, like there's not a lot of risk in cash, right? Like the risk of misstatement, I would say, is low. And again, the beautiful thing about audit, it's very judgmental, right? Like you can document one thing, and as long as your documentation can support your conclusion, you should be fine. So in our aspect, like I don't know. I can't see why the risk of misstatement at cash would be high. I consider that low. I mean, we're going to send a confirmation. We're going to confirm. We're going to receive a bank reconciliation. Overall, I think we should be okay saying risk of misstatement high for accounts receivable. I would say high because obviously it involves revenue. Revenue is susceptible to fraud always, and it's a material amount. You know what? On cash, I think we could say, yeah, the risk of misstatement I think is low. Risk of misstatement for accounts receivable, high. Okay, as we continue on here, so let's go through. And as you can see here, our system automatically, if it was not quantitatively material, it kind of grayed everything out. So if it's not quantitatively material, and you know what, let's go back here. If it's not quantitatively material, we essentially kind of grade everything out. We just kind of said, all right, well, yeah, we don't need to necessarily worry about it. Not that if something is quantitatively material, by default, it doesn't mean that you're not going to do anything over it. It just essentially means, hey, it's not quantitatively material unless there's qualitative factors or there's an estimate involved to calculate the account or something along those lines. You can scope it out if you're testing, okay? So going back here, so risk of misstatement for inventory, again, I think that's very high because again, inventory, it's a material account. There's cost accounting involved. It has estimates involved with slow moving inventory. So I would definitely say there's a high risk of misstatement. For PP&E, I would say that's medium. I mean, look, we have our PP&E from last year that maybe someone audited. We're going to look at additions, disposals during the year. So overall, I would say medium. Right of use asset, there's definitely a calculation involved. If you've ever worked on, if you ever audited leases before, you would know that there's a calculation behind this. You either have to use a software or an Excel template that you can calculate this with. So I would say the risk of misstatement is high, and given that it is material, I would say that the right of use asset, the risk of misstatement is high. Accounts payable, same thing. Risk of misstatement is high. Not that it's an estimate, but you can miss certain payables if you don't record them on time. Like let's say, for example, they didn't receive, they don't get an invoice on time, but they received the product before, which happens all the time. They wouldn't have maybe accrued for it properly. So I would say the risk of misstatement is high because the risk with payables is that there's an understatement of those payables. So you want to make sure that, again, the risk of misstatement I think would be high for certain payables. Accrued expenses, same thing. Notes payable, I would say medium because again, we're going to confirm that at year end. And that's really it. I mean, you send a confirmation for payables. You essentially send a confirmation to the bank saying, hey, how much does my client owe you at a certain period in time? And that's what and we move on. Same thing, notes payable current, notes payable long term. Equity, I would say medium unless a company is issuing a bunch of stock. And you can start asking these questions on like when you're auditing your companies, if company's issuing a bunch of stock, then you can ask them. But other than that, I mean, if a company's really only activity in equity is going to be the net income or loss for the year, then I would say it's medium. I mean, there's not a lot of risk in there. Okay, revenue, cost of goods sold, and SG&A. I would say that's high because given the dollar amounts, look at these. Our performance materiality is 1.1 million and our revenue is 14.7 million. Cost of goods sold is 5.6 and SG&A is 5.4. I mean, just the sheer dollar value of these, it leads me to say, yes, there is a high risk of misstatement. And again, every audit software is going to be different and it might even populate this for you, and especially with AI now and how good it is. But that being said, that's why you're here. You need to validate that all these responses are correct. So that's essentially what we do for the risk of misstatement. And then whether an account is significant or not, it's essentially significant whether it's quantitatively significant or qualitatively significant. In our example here, as you can see, if we filter out all the no's and we just keep the yeses, if we do that, you'll see here, pretty much if it's quantitatively significant, that means that the account is going to be significant to the financial statements. Therefore, we need to include it in our audit. So as we continue on, you know what, for our example's sake, and let's continue on, sorry. Okay, so now let's go over significant risk. So this is always an area that gets kind of complicated, and especially when I was like a young auditor, I would always ask myself like, why? Well, what makes an account significant risk? And okay, the reason this matters so much is because when you're doing your statistical sampling, when you're going to be doing sampling over an account, if you say an account is a significant risk, it's going to increase your sample substantially. Let's say, for example, you were doing a testing over cash, and you subjected cash to testing to a sample, then essentially what would happen is, let's say you had to make just 3 samples from your non-statistical sample, but if you considered it cash a significant risk, then essentially that you would have to apply your procedures as you're applying a significant risk, which is going which is going to expand your testing so much. I'm telling you, I've seen it in practice where samples can, a sample size can go from literally 10 to like 30. And that's a huge difference in as far as what you need to do and the extent of the procedures you need to do over a certain account. So again, a significant risk, and I wrote down, let's see here, subset of risk of material misstatement, significant estimates. Okay, so really things to look out for is like complexity, if there's fraud risk involved, revenue recognition, management override controls, certain things like that you need to look out for. But overall, I would not say cash is anything you label a significant risk, your procedures need to reflect that. So again, you can always document around that. And I think there's always a lot of judgment involved, but typically in my career, I've always seen either revenue around cutoff be a significant risk, and certain management override controls, which is obviously by default just audit standards. You would have to consider those two are always in my career. And typically, if we add another one in there, it's because there's a lot of complexity involved. There's someone we need to involve a specialist. We typically can't come up with the number ourselves, so that's why typically we would label those as significant risk. But for the most part, most of your accounts are not going to be what we call, again, a significant risk, because your procedures need to be reflective of you labeling an account a significant risk. Does that kind of make sense? Hopefully. Again, it can be very confusing, but at the end of the day, just remember, typically in your audits, you're going to have revenue recognition sometimes around cutoff, or revenue recognition in general, because again, it's susceptible to fraud, and management override controls. And typically for those two, you would test revenue from a revenue perspective, from a detail testing perspective, and then obviously for management override controls, you would do some type of journal entry testing where you test all manual journal entries or journal entries at a certain period of time in order to assess that risk. But again, if you label an account significant risk, it's going to drastically change your procedures. That's why you have to be very careful. So in our example, everything is literally no to significant risk here. And again, especially if it's already been a not quantitatively significant. So we labeled everything no here. Right, use asset, accounts payable. Okay, equity, no. And as you can see here, revenue, automatically it hit yes. Revenue is a significant risk because it's susceptible to fraud. And revenue, essentially, for the majority of companies you're going to be auditing in practice, it's going to drive a lot of management decisions and what they do. So you need to do extra procedures over this account balance to get comfortable with it from an audit perspective. So essentially, you need to label that as a significant risk. Okay, awesome. All right, so now let's go over our rationale. So now let me make this a little smaller just so you guys can get a feel of everything. Okay, so now that we've pretty much gone through it all, let's go through our rationale to see how we documented this and how we came up with our conclusion. So we're going to go through every single account, and then hopefully after we go through each account and the documentation and our rationale, you'll understand how we came up with our conclusion. So cash is it material? Yes, because it's above performance materiality. Is there an estimate involved? No. Risk of misstatement? Low. Significant? Yes, because again, it's quantitatively material. Significant risk? No. And our rationale, it's susceptible to theft or fraud. So that's essentially, so it's material and it's susceptible to theft or fraud. So again, it's significant, and we're going to be doing some testing over it. So great. So hopefully you kind of understanding that. So accounts receivable, it's material. Is there an estimate involved? Yes. Allowance for credit losses. Risk of misstatement, it's high. Significant? Yes, it's quantitatively significant. And is there a significant risk? No. And immaterial and includes management estimate. That's essentially our documentation and our rationale why we concluded on all these different things. So, and then we're going to go ahead and go over prepaid expenses. So prepaid expenses, essentially all of these that are not quantitatively material, there's not really a big risk with prepaid expenses, right? I mean, and then it's 700,000. It's literally it's a little bit more than half than our performance materiality, but overall, non-material, low risk, excluded from scope. So these three, I'll go through them quickly. So prepaid expenses, other current assets, and investments, all of these are not quantitatively material, and therefore you can exclude them. Non-material, there's low risk, and you can exclude them from the scope. So essentially what that means is we don't need to include these accounts in our testing. We can literally exclude them in total. So no need to do anything over these accounts. Okay, so inventory, as we continue to go on through our through the accounts. Inventory is material and it includes management estimates, which includes obsolescence. So yes, so it's material. Is there an estimate involved? Yes, it involves slow moving and obsolescence reserve. Risk of misstatement is high. Significant? Yes, it's quantitatively significant. And is there a significant risk? Well, no, not really. Again, if you label an account significant risk, you need to do extra procedures and your procedures need to be reflective of that. So not a significant risk. We go here, property, plant, and equipment. So is it material? Yes. Estimate involved? Yes. Useful lives. Risk of misstatement? It's medium. Significant account? Yes. Again, it's quantitatively material. Is there a significant risk? No. And it's material and it includes management estimate. That's essentially our rationale why we came up with our conclusions. Again, intangible assets, $450,000. It's not quantitatively material, scoped out. And the reason for that, non-material for this audit, low risk of material misstatement due to lack of impairment indicators. It doesn't appear that there's an impairment indicators with the company, so that's why we completely scoped it out. Right of use asset, we put yes, material estimation involved, no. And I'll kind of go through these quickly. You guys can kind of see the answers. But essentially, we came up with our rationale for right of use assets because it's material and it includes calculation to record right of use assets. That's essentially why we said it's material. There's an estimate involved. Risk of misstatement is high. Significant, yes, but not a significant risk. Accounts payable, same thing. So accounts payable is material. There's an estimate involved. There's a risk of misstatement and risk of misstatement, significant. There's no significant risk. And we said it's material liability account with risk of understatement. Again, with your liabilities accounts, the risk of understatement is the risk is always understatement because the risk is that the company didn't unfortunately accrue or record for something. And that's essentially debit expense, credit the payable. Okay. So we'll skip through these again because essentially they come up with the same thing. Notes payable, it's material. There's an estimate involved. There's no estimate involved with notes payable. The risk of misstatement, medium. I mean, again, we're going to send a confirmation. Nothing to worry about there. Is it significant? Yes, because it's quantitatively significant, right? Is there a significant risk? No. Again, significant risk. We need to expand our procedures to reflect that. And how we came up with this? Again, same conclusion for both. It's a material financing account. The testing required to verify debt agreements, and then testing's required to verify debt agreements, interest, and current classification. So again, that's why we came up with our conclusion. Essentially, the whole purpose of this work paper is to say, hey, we're going to include it or exclude it as part of our audit procedures. And in our case, for debt, we're going to include it, and that's the reason we came up with our conclusion. Again, these are not material, so we're going to skip through these. We're going to go all the way to revenue because, again, you guys can kind of read through how we came up with the rest of the conclusions. So for revenue, for example, is it material? Yes. Is there an estimate involved? Yes. Variable consideration. Is variable consideration. Risk of misstatement? High. Is it significant? Yes. Significant risk? Yes, of course, because there's a risk of fraud. And then the rationale why we came up with what we came up with, and you guys can see here, we'll put that here. Revenue is material and subject to fraud risk. Revenue is material and subject to fraud risk. Variable consideration and cutoff timing increase risk of misstatement. Again, remember that? Variable consideration and cutoff timing increase the risk of misstatement and require significant risk response to testing. Again, when we do our testing, you'll go through, you need to label revenue a significant risk, which is by default going to increase the amount of testing you need to do. So it's going to expand it by a lot. So again, I'm telling you, you need to have a good rationale why you're labeling something a significant risk or not. Okay. So as we continue to move on here, cost of goods sold. So cost of goods sold, is it material? Yes. Is there an estimate involved? No. Risk of misstatement, high. Let me move this here. The risk of misstatement, high. Significant? Yes. Is there a significant risk? No, there's not necessarily a significant risk. Again, it's more around revenue and management override controls. And if there's another account that involves a lot of subjectivity, there's a calculation, you need to get a professional, somewhat of specialist involved, then you start thinking about that. But for the most part, no. Cost of goods sold is not a significant risk. And it's material. And so the reason that we labeled all these things is it's material and analytically linked to revenue. It includes risk of improper cutoff or expense classification and tested to validate margin consistency and inventory tie-out. Okay, so that's the rationale behind it. And last one here that we're going to go over, SG&A, is it material? Yes. Is there an estimate involved? No. Is it risk of misstatement is high because given the dollar value of it? Is it significant? Yes, it's a significant account. Is there a significant risk? No, there's not, because again, there's no management specialist we need to get involved, and especially this company is in our example, it's like it's a merchandising company, so their SG&A is going to be like, I don't know, utilities, the water, rent, certain things that they're going to operating expenses to run their business. So there's not a lot of susceptibility to like a specialist or some type of complex transaction to calculate their expenses. So I don't think there's a significant risk. And our rationale behind it is material and includes subjectivity in accrued bonuses, commissions, and or company spend. Tested for classification, accuracy, and completeness. So SG&A is going to be driven again by the accruals that we record, but I mean, they don't need a specialist to record accrued bonuses, right? They don't need a specialist to accrued interest. They don't need a specialist, to record commissions, right? That's something that they calculate internally, but should that be significant risk? No, because again, we would need to expand drastically our procedures if we're going to label it as significant risk. And let's go over interest expense. That actually account didn't come out as material. And is there an estimate involved between interest expense? You know what? I'm actually going to say, well, yes, kind of. Yeah, because you need to accrue for your interest. So you know what? We're actually going to update this. Is there an estimate involved in interest expense? Yeah, because you need to record accrued interest. You sometimes need to calculate how much interest am I going to accrue, and sometimes it can be material. So I would say yes, there is an estimate involved with interest expense. Is a risk a misstatement? I would say, given that it's $585,000 for the year, I would say it's low. I mean, given that, okay, let's think about this. And this is where I'm telling you, like, this is where it's so judgmental, and it's really being contingent upon the auditor. Obviously, there are certain things that are black and white, but there's a lot of gray area in audit where you can think about, okay, well, what should we label this? Like, how should we come up with it? I would say, given that it's $585,000, I mean, you would have to literally double it in order for it to be material. I'm going to say low, and you can challenge me on that in the comments if you want, but I'm going to say low. I think the risk of misstatement for this is low. Is it significant? We're going to say yes, just because it's part of the debt, right? So that's why essentially it's not quantitatively significant, but qualitatively we have to look at factors, and it's already part of debt anyways, so it's going to be part of our debt testing. And then our rationale behind it, and then if we go to our rationale, we're going to say expense related to notes payable required for tie out to debt schedules and accuracy of effective interest rates. Again, it's kind of tied to debt, so that's why we're including it in here. And then everything, and as you can see here, everything we grade out, we documented, we added a tick mark. We said, auditor noted that this balance is not quantitatively or qualitatively material. As such, will be scoped out for testing. Additionally, auditor noted that, and then let's see here, did I add anything else? Oh, shoot. All right, let's make this a little bigger here. Okay, boom, boom, great. All right, what else did we put? Let's add a border to that. We said, additionally, auditor noted that, what the heck? All right, let's go back down here. You know what? I think I didn't finish documenting this, but all right. The great part, let's just say, auditor noted that this balance is not quantitatively or qualitative, and such, it will be scoped out for testing. Yeah, that's it. We can end the sentence there. There's really nothing else we need to document. Essentially, we're telling the reviewer, hey, we scoped out these accounts because they're not quantitatively or qualitatively material. So that concludes our kind of presentation through our audit series number 6 on identifying significant accounts, significant estimates, and significant risk. Hopefully, again, the whole purpose of this is once you calculate your materiality, like we went through in audit series number 5, then you start going through and asking yourself, okay, what is going to be included in the scope of our audit, whether it's quantitatively material, qualitatively material, if there's an estimate involved, and lastly, is it a significant risk or not? Because again, this is going to drastically change the way we approach the account and the scope of the work that we're going to be doing over the account. So hopefully you found this video helpful. Again, go ahead and download the template in the description below. That's on my website for you to follow along. You can play with it, and then again, you can kind of see how things change if you make things not quantitative material. And if there's certain things that weren't clear in the video, please let me know in the comments below. Hopefully you found this helpful. Until next time, peace.